are live. Sometimes going live for me is like a minor miracle with everything in life going on. You've chosen to join me, and I greatly appreciate your time. I'm Mitch Goldberg. Welcome to Be the Boss of Your Money. This is my live stream about investing, personal finance, borrowing, credit, assets, liabilities, spending habits, emotions, the psychology of money, all so that you could be the boss of your money. I just want to help you make better decisions. That's all. Because when you get your dose straight, just so many things in life can go that much better. There's enough friction in life, but at least if we could get things straightened out with personal finance, that takes a lot of pressure off. And that's what I want to do for you. I want to help you reduce the pressure. Today, big bounce back in the stock market. The Fed has spoken. We crossed, or I should say we cleared the three big hurdles this month: the non-farm payroll numbers, the inflation figures, and the Federal Reserve meeting. We live to tell the tale, and the market, investors have spoken, and we like what we see. So let's roll the intro, and then we're going to get into this. We're going to have a good show. So here we go. Hey there. Thank you for joining me. I'm Mitch Goldberg. We are just getting started. We're talking about the market, the FOMC meeting. I'm going to explain what that is. Let me just start with that. FOMC, Federal Open Market Committee. Okay, FOMC. The Federal Reserve is the central bank of the United States. This is the body that controls short-term interest rates. It regulates the banking sector. It does things to help stimulate the economy or slow the economy down. Sometimes the economy does go too fast. And when the economy goes too fast, and I know what you're thinking, how could that be bad? But if the economy goes too fast, we get something called inflation, higher prices. And we could talk about taxes and spending money and all that, but higher inflation just means that you're losing money. Your money doesn't go as far. You're spending money. And that's the whole point of what the Federal Reserve does. The Federal Reserve has a dual mandate, if you didn't know. The first one is called price stability. I know a lot of people say the first one is inflation. No, it's price stability. Being inflation or deflation, the Fed, one of its two mandates is to keep prices growing very slowly and steadily. And the agreed upon growth rate of the economy is 2%. Am I coming in clear to you? Let me know. Give me a thumbs up if I'm coming in clear. Give me the ear emoji if I'm coming in clear. And while you're watching this, if you have any questions, words of wisdom, words of encouragement, they're always appreciated here. And I do love hearing from you. So please go ahead and hit me up with any questions you may have. So the first mandate of the Federal Reserve, central bank of the United States, is price stability. The second one is maximize. The second one is to maximize employment, and that means keeping the unemployment rate as low as possible without hurting price stability. So if we have, I know this is going to sound kind of funny to you, but if we have too many people working and the economy is too strong and people are spending a lot of money and it's creating inflation in it's creating inflation, which is an environment in which prices generally rise persistently, the Fed has to do something and slow the economy down. So they could raise borrowing costs. So you think about whenever you borrow money, if the interest rate goes up, your borrowing costs go up. So maybe that'll hurt demand for loans, for hurt demands for money. Okay. We call interest rates the cost of money. You borrow money, how much does it cost? Well, it costs you interest. How much interest? Is it 2%? Is it 4%? Is it 6%? Is it a credit card that's like 18%? Is it a mortgage that's about 3%? That's the cost of money. So there are other ways to gauge the strength of the economy, by the way. It's not just inflation, it's not just employment. We have other measures such as we have other measures such as GDP, exports, imports, corporate revenues. There are so many ways and so many statistics at our disposal, which basically helps us decipher the strength or weakness of the economy and the ramifications of that. Stronger economy is usually a good thing until we get too much inflation, and then it saps demand. So people can't afford to buy as much stuff. So even though you might go to the supermarket or a store or online and spend $200, well, now to get the same amount of stuff, you'd have to maybe spend $230. So instead, you'll say, well, I'm just spending the $200 and I'll get less stuff. That getting less stuff for the same amount of money means demand is going down. That's how demand gets sapped by inflation. So that's one thing. What else? Employment. Now, we've had a remarkable recovery in the employment picture since the start of the pandemic in early 2020. But there have been a lot of people who have dropped out of the workforce. And a lot of these people, a lot of these people are never going back into the workforce. There's a few reasons why people dropped out of the workforce. It's, there are people who are out of the workforce because they're just worried about COVID, or they're a caretaker, or they have loved ones to take care of. And now we've got the Omicron. I saw a report today from the CDC that as much as 13% of COVID cases in New York and in New Jersey are Omicron, of the Omicron variant of COVID. Could be worse in other places, but it seems to be spreading like crazy. Shout out. This is not really a shout out, but I'll just say it sarcastically. Shout out to the people I know who went to an event last Thursday of last week, in which they didn't want to do drug testing, or not drug. They didn't want to do COVID testing. They didn't want to do COVID testing. So if you want to go into the event, you have to have proof of a negative COVID test. Nope, we're not doing that, just because there are a few obstinate people who don't believe in vaccines. Shout out to you guys, who then sent out a broadcast email a few days later. Said, turns out there's somebody who's positive with COVID. Could be more than one. It could have spread to others. And instead of staying home for 10 days, quarantining, not exposing anyone else, shout out to all the people who actually went out to another event without a mask last night, just 5 days later. And this is how stuff spreads, by the way. This is how pandemics work. Obstinate people who, instead of quarantining, or not, at least not going out to an event with hundreds of people, for an event with people of all different ages, including, it was a under 40 event, so there were parents of people who are older. But what can you do? And this is the kind of thing we see all over. And no, I am not for living like a sheep, or something like that. I'm just for being careful. What's wrong with that? Hasn't affected my life by being careful. If anything, my life is better because of it. Okay, but that's me. Let me go on. Okay, so I'm really on a riff here. Employment. So the employment picture has improved greatly since the beginning of the pandemic, to the point where it's hard to hire people, and partly because people have left the workforce. And why? A lot of retirees. Well, why a lot of retirees? Well, part of it is because retirees' houses people who are homeowners, their homes have gone up in value. So they have more money than they thought they would have. Maybe they're tapping into equity, they're doing reverse mortgages, or selling their house and moving into a smaller house or into a cheaper region of the country. But a lot of people also have stocks, 401ks, IRA rollovers, and they have gone up so much that people are thinking, wow, I have more money than I thought I would. My whole financial plan has been accelerated because the stock market has gone up so much that I don't need to do this anymore. I'm not going back to work. And congratulations, you've earned it, and I'm happy for you. But the stock market is notorious for creating a wealth effect that is often ephemeral, that can be withdrawn. You could see the rug pulled out from under you in a severe stock market downturn. And we've seen that happen also in the past. This is we saw it in 2000, we saw it in 2008, 2009. It's been a long time. It seems like people forget. We forget the lessons and we forget risk management. Okay, so I'm a little off track here. Let me get back on Federal Reserve, dual mandate. The Federal Reserve calls the shots. The street was expecting the Federal Reserve to come out and say, holy shit, we fell behind the curve on inflation. We are going to have to tighten monetary stimulus, get rid of monetary stimulus. We're going to have to tighten the money supply, shrink liquidity, get rid of the taper really, really fast, and jack up interest rates because we're behind the inflation curve. And investors were getting ready for that. And they've been getting ready for that for like the last month and a half, but it really accelerated the Friday after Thanksgiving when the Dow was down 905 points. We've had lots of tremors and aftershocks and spikes and then big down days, lots of everything since then. But today the Fed was very careful, very deliberate, and very clear and reassuring. The Fed said, yeah, we're going to do what we warned you. We're going to taper our bond purchases quicker. Will be done in March instead of June, which the Fed has been signaling this. So that's not a surprise. And they said, we're looking for interest rates, maybe 3 hikes next year and 3 the following year. A lot of people are expecting 2 or 3 rate hikes in 2022, and 2023 the following year would be like 4, but it's like 3 and 3. And 6 rate hikes is 1.5% on the Fed funds rate. Not the end of the world. Okay, investors have gotten ready for this by getting out of the high flying, overvalued stocks like the pandemic stocks. The DoorDashes, the Zooms. Okay, the kind of stocks that really, the Rokus of the world, the kind of stocks that really took off because people were staying at home, working from home, and relied on these companies, and these companies their stocks did very well, and now their earnings and their revenue growth have slowed down markedly, and all of a sudden people are like, I can't pay such high prices for these stocks. It's not worth it. And these stocks got crushed. Meme stocks got hit, right? Meme stocks just got mauled. And money went into more, I would say, stable type of investments. Money went into bonds in spite of the fact that people think the Fed could raise rates. Long-term bond rates have gone down. People went into industrial stocks, companies that make things, companies with earnings, dividends, stock buybacks, things that investors feel comfortable holding on to. Okay. And if the Fed is expected to raise rates, it lowers the future value of high-flying companies' cash flow, or lack thereof, because a lot of these companies don't have cash flow. They have revenues, but they're losing money. And they're losing money in the name of buying their growth. They're paying for their growth so that one day they turn on the spigot and all of a sudden they're making money. This is what Amazon did. Amazon was able to make it through by always showing losses because they reinvested all their money into new areas, new capacity. And then one day they just couldn't help it. They just started making a ton of money, especially in the cloud business. So that was Amazon. But how many companies are really the next Amazon? And we don't know who it is until well after the fact. So that's what happened. Let's take a look at the screen. All right. Let's do a quick share screen. All right. I'm going to do a quick share screen. All right. So let's take a look at the FANG stocks. I'm just going to make my screen a little bigger so you could see it better on your little smartphone device. Apple 179, almost to its year high. I think Apple has to go to like 186, is it? 184, something like that. And it'll hit the $3 trillion valuation. I mean, that is a staggering amount. If you look at Amazon, you see that red over here and green. The red is its year high. The green, the all the way to the right is the year high. All the way to the left is the year low. And this is where, and the stock is in between. There's a good amount of red here. There's a lot more red here than in recent months. Facebook, is down 20%. Facebook's had a correction. Google is not too far off. Microsoft is not too far off. Nvidia is a good deal off its high, about just as of this morning, I did a quick calculation. It was up like 20% from its high. All right, and let's take a look at how the overall market did. Well, I've got you here. Okay, this is not what I want to use. Okay, so yeah, here we go. The Dow was up 383. It was down, and then it was basically flattish. And then into the afternoon, it just rallied almost 400 points into the close. Nasdaq had a really big day, and that was down a lot today. So Nasdaq had a huge turnaround, up over 2%. S&P was down a little bit most of the day. Toward the end of the day, had a big rally, and it just looks like people were a little too worried about what the Fed was going to do. People got defensive. They took money off the table. They were reassured by the Fed. They got back in, and here we are with a nice little rally on the day. And maybe this will be the true beginning of the Santa rally that people like to talk about. Energy was up a little bit. 10-year yield was barely up. It's very perplexing how that never goes up. Not to say that never goes up, but it's still so low. Oil is low. Gold is low. These three numbers right here, okay? Gold, oil, and the 10-year yield. These should, in my opinion, all be higher if we're really seeing economic acceleration and we're really seeing sticky, long-lasting inflation. These, I think, should be higher. And that's one reason the message is that investors' 5-year outlook for inflation is only like 2.7%, which is just about baseline of the last couple of years. So people are still expecting inflation to moderate. And there's two ways inflation could moderate. Okay? There are two ways that inflation could moderate. Prices could generally go down. Okay? And you could see that maybe with supply chain disruptions finally becoming fixed. We have not only more supply of goods, but we have faster, easier, and a smoother delivery of goods. Another way that inflation could come down or moderate is if prices simply stay where they are. Because if you have inflation last year of, let's say, 7%, the price of goods overall last year went up 7%, and then this year they didn't go up at all, you know what the inflation rate would be? 0. So that's another way that see, inflation measures the most recent rise year over year in prices. So if prices freeze, then you have no inflation, even if they were up a lot the year before. So that's another way that inflation works. Okay. So the VIX below 20. And what do we always say? The VIX goes below 20. See, it's 19.29. We get a rally in the stock market. And here we are. VIX below 20, stock market rallies. And since the VIX closed under 20, it looks like the rally is going to be sticky. And the Russ 2K, small caps up 1.65%. That's a pretty good move. Let's take a look at crypto. Crypto is off quite a bit yesterday. So today, crypto was, it didn't quite gain what it lost yesterday, but still decent day for crypto. crypto is a reflection of a couple of things, but overall a decent day for crypto. I just want to take a look at the Dogecoin unchanged. See, Elon Musk touted Dogecoin yesterday, saying, "Yeah, we would accept Dogecoin for payment for certain things." I don't know if he meant for cars or accessories or what have you, but I really get a little pissed off when someone like an Elon Musk decides to tout a small crypto or anything small. Can you imagine if Warren Buffett came out and gave you a penny stock and touted it? The stock would rise and then it would go down, right? It's just you've got to be careful when you open up your mouth in the public arena. All right. I know you're saying, well, you're all adults. You make up your own minds. No, not everybody has the sophistication to realize that when you achieve that, this is not the right word, but that, it, not, when you achieve that kind of cultural status symbol that Elon Musk has reached, and you talk about a crypto or a stock, people get excited about that and they rush into it. They don't. They buy first and ask questions later. You've got to be careful what you say. So I think crypto. A lot of people are saying that crypto is a reflection of too much money printing, dollar debasement, fiat currency debasement, meaning we're not developed economies are not taking good care of their inflation. Let me say that again. Developed economies, it's believed by crypto enthusiasts that developed economies are not being good stewards of their currency. So, therefore, we need to hold as a store of value something other than fiat currency. I have to look up where that expression fiat came from. But instead of holding on to dollars or euros or yen or pounds, let's hold on to Ethereum or Bitcoin or Litecoin or a basket of cryptos. But I also think cryptos is symbolic of froth, of so much money, so much liquidity sloshing around in the financial system. That money is now going into the most speculative stuff that it could find because it's run out of other things to go into. And that's why you saw meme stocks go up, they came down. A lot of crypto's gone up, a lot of it's come down. But if the Federal Reserve is finally raising rates or getting very close to raising rates, it's a matter of months. It could be next June. It's 6 months. It's 6 months away till the Fed starts to raise rates. In the scheme of things, 6 months is not that long. The next 6 months are going to go by like that. So if we are raising rates, the Fed's pulling back on stimulus, taking better care of the currency, that actually is good for the dollar and is probably negative for crypto. That's what I think. On the other hand, crypto is becoming more widely adopted by investors all over the world. So there's still, only a small percentage of people that own crypto. So the belief is that as more people become enthusiastic about crypto, as more corporations become more enthusiastic about crypto, crypto will continue to be bought, continue to rise. Last I heard, there's something like 11 or 12,000, maybe more different cryptos out there. So who knows which one is going to be the big one, the big winner. I don't know if it's going to be Bitcoin or not. That's what people say. Like, oh, Bitcoin's the leader. We'll see. But 2 or 3 years in the world of crypto, that is an eternity, and a lot of things can change. So we'll see. But that's what makes it fun, and that's what makes it speculative at the same time. It's a gamble, and you need to know the difference between between gambling and investing. All right, gambling is the longer you gamble, the lower your odds are of winning. Investing means that the longer you invest, the higher your odds are of winning. There's a big difference. So that's my story. Let's go back to the tape, to the video. Up, wrong place. Okay, I'm back here. All right, I put myself in the other corner. All right, Let's take a look at back to the watch list. So let's take a look at what did well today. Sector ETFs. Okay. Uh, Technology recovered nicely. Let me make this even a little smaller so we could get a better view. All right. Technology recovered nicely, not too far from an all-time high. Healthcare hit a new high. Money went into utilities. REITs, these are basically defensive. So this was more or less a defensive rally. It did include everything. I mean, industrials were up modestly. Financials were up modestly. Energy was off. Okay, so it did include everything. Energy was off a little bit. I like to see industrials, financials, materials, and energy. These four right here. Okay, 1, 2, 3, 4. These are the ETFs from Spiders from State Street that that comprise of the sector stocks. Okay, of the 11 sectors of the economy. These four I would rather see leading the way up than trailing. So today was more or less a defensive kind of rally. Make sure I didn't miss anything. Okay. So as far as the Fed goes, it was a little bit less hawkish, and they're not going to. It doesn't feel like it's behind the inflation curve as much as people thought it would acknowledge, but it delays the it delays the inevitable. The rates are going higher. That over a decade of stimulus and balance sheet expansion of the Federal Reserve's balance sheet. That stuff, though, is changing. Those factors which have propelled valuations is going away. Now, do we find something else to propel asset valuations? It's really tough to say. The really tough thing is that the Federal Reserve is trying to thread this needle between not hurting financial markets like stocks and bonds while trying to steady the economy as much as possible by putting a limit on inflation. And I say threading the needle because it's hard to have all three. If the Fed didn't worry about the stock market, it would do a lot more. The Fed has been very careful in warning investors very early in advance of any move it's considering, so that by the time the Fed makes a move, it's already a non-event. Like, we're so sick and tired of hearing about it that it's like a personal relief to when the Fed finally does something. And that's the Fed style. Warn in advance, warn in advance, warn in advance. Give investors time to adjust. Because if the stock market really did tank, which could cause a problem in the bond market and the housing market and everything else, because the financial markets are so tied to the real economy, that could throw us into a recession and create dislocations. Nobody wants that. So the Fed is very cognizant of what its actions and what it says does to the stock market. It used to be, I don't want to sound like these people, oh, when I was a kid, no. But I have to tell you, it used to be the Fed didn't really worry so much about the stock market like it does today. And I'm wondering if we would actually be better off long term if the Fed would stop caring about the stock market, just focus on the economy. If you focus on the economy, the stock market will take care of itself. It'll be painful over the near term, but I think maybe better or more stable over the long term. Okay. So it doesn't change my mind at all about what we've been talking about. All right. I still think the speculative stuff, the SPACs, meme stocks, etc. I still think that stuff, those kinds of stocks, will continue to be a source of liquidity for investors to buy what they feel are an upgrade in terms of asset quality to put their money into. I also want to reiterate the market has cleared its hurdles. We had the non-farm payroll figures earlier this month, then the inflation figures, and then the Fed meeting, which ended today, and they had their statement after the meeting today at around 2:30. Eastern time today. We've gotten through all of those. And the next big thing is earnings, which we're not going to hear about until the second week of January. And then we're going to be listening very carefully to commentary about 2022 from CEOs and CFOs. That's the next big thing in terms of what are they seeing with employment, with inflation. Do they see business continuing? Um, Today, Lowe's took a hit, the big home improvement chain, because they said that they expect things, and they already are seeing things slow down since the pandemic. People aren't doing as much with their houses because they're going out more and just they're not putting all their money into their house. So um, it's creating dislocations, and a lot of the stocks that benefited from the pandemic, which is a great many, are probably still going to be a source of liquidity to buy stocks that could benefit for coming out of the pandemic, for reopening. All right, so that's my story. I'm sticking with it. I thank you so much for checking us out today. If you have any questions, hit me up in the comments. Even after this show, I will definitely see those. And I want to thank all of you. And I'll be back tomorrow. And I'm looking forward to that. We'll have another good show. Thank you.